The Chinese called it Black Monday. This week began with China's stock market losing 8.5% of its value, the biggest drop since 2007. Then the rest of the world woke up and things got brutal. Before partially recovering on Tuesday, Europe's 300 biggest companies dropped in value by more than $260 billion. In the US, the stock indexes had their biggest drop since the global financial crisis of 2008. But why is the Chinese economy affecting the rest of the world? Well, many companies, including lots of American ones like Apple, manufacture their products in China. They also sell those products to Chinese consumers. Then you have countries that sell commodities like coal, metals, and oil that thrive off of Chinese demand. So when China's economy slows down, as it has been for the past few years now, the rest of the world feels it. One of the ways China's government has tried to boost its economy is by allowing ordinary Chinese people to start borrowing money to buy stocks. That sent the price of Chinese stocks soaring, much higher than what they're actually worth. But since June, those overvalued stock prices have been dropping, and now the bubbles burst. Investors around the world, including in the US, took a look at what's happening in China and started to panic, wondering, could this happen here too? When investors panic, they sell their stocks. That's why other financial markets took such a beating. So, is this the start of another global financial crisis? Well, probably not. The stock market is not the economy. And while stocks dropping might sometimes indicate economic downturn, other times it's just stocks acting like they do. They go up and down depending on profit forecasts. But forget about all the jargon. How does this actually affect you? Well, unless you're rich, you're probably not a big investor in the stock market. Only about a quarter of folks under 30 even own stocks. Those that do might have them in a pension plan like a 401k. Those might be affected in the short term, but you should remember that these are long-term investments. As economist Dean Baker told us,
unless you happen to buy yesterday or buy last week and be selling today, most people are still way up in the stock they own. So in other words, if you'd bought stock a year ago, 2 years ago, it's selling for much more today, at least on average.
Baker also says lower stock prices might actually be good for us young folks, because if we do want to invest in the future, lower prices could mean higher returns. So don't panic just yet. But since China is the world's second biggest economy, we'd all be wise to keep an eye on what's happening there.